you do not invest in gold, right? And if you see last year, gold has given upwards of 20% returns. And you mentioned that your FIRE number is somewhere close to 50 crores.
Right. It's not evident to me that anything less than 30-40 crores will allow you to have a decent retirement. Bajaj Finance, we backed up the truck. The stock tripled in the next 2 years.
Okay. Right? So how do you identify whether the markets are undervalued, overvalued, or do you not really care and you just invest whenever? Most people know you. You're a celebrity fund manager who is managing almost $1 billion. I myself began my financial journey listening and learning from people like you. I still remember reading your book, Coffee Can Investing, 5 years back. And that was a game changer in my entire journey of learning about finance. Because, see, I was a mechanical engineer, right? Most people assume that, I was a CA or I was an MBA degree, and people can't digest the fact that I just did mechanical engineering. But the secret to that is listening and learning from people like you. So thank you so much for helping.
My pleasure.
Yeah. So how many copies has your book been sold?
I think officially the publisher tells us something close to 100,000. But I suspect
100,000 copies.
Yeah, but in Indian publishing, if it's 10,000 is a bestseller.
What is the most amount of money you've made in a single year?
Right. So it was a stock which quadrupled on us over the course of basically 12 months, right?
So 4x in 12 months.
So I started reading a few annual reports which were on my laptop, and I read about a company called GMM Pfaudler, right? So I read that they make these ceramic vessels, right? Much like a giant version of this coffee cup. And in those vessels, pharmaceutical products are made. So I said, this is insane. I mean, world leader. And I looked online. They've been making good return on capital. Return on capital is profits divided by how much money has been put in the company.
Okay.
So I said, not only world leading company, highly profitable. So much like nobody ever got sacked for buying IBM, purane zamane mein.
Yeah.
Nobody in the pharma industry ever gets sacked for buying Pfaudler. So we invested in GMM Pfaudler. It was one of our first stocks in our small cap portfolio. Over the next 12 months, GMM Pfaudler did all right. I think we were up 20 or 30%. And then COVID arrived. Right? And then COVID arrived. And demand for pharmaceuticals obviously went through the roof. Demand for GMM Pfaudler went through the roof.
And you made 4x on your investment.
By autumn of 2020, the stock had gone into the stratosphere. And once it went into the stratosphere, we obviously cut the position back, because if share prices are run up far more than profits, it's time to pull the position back. So we pulled the position back. We're still shareholders though. And profit compounding has been stellar over the last 3 years. Guess what? The share price hasn't moved much in the last 3 years.
Okay.
So perhaps time to
remove.
No, perhaps time to load up further.
Profit. Okay.
Profits have continued growing over the last 3 years.
But the share price has not.
Share price hasn't moved because most people bought after the initial frenzy. So people chase yesterday's winners, right? So rather than buying HDFC Bank today, they will buy some stock which has gone up 10x in the last 2 years.
Like Nvidia or Tesla.
Right, absolutely, right? And that human habit to chase yesterday's winners, where the winning has been out of all proportion with profit compounding, right? That habit is incredibly destructive, as is the habit of ignoring companies where the share prices have stayed constant, or the share prices have indeed sunk, even though profits are through the roof.
So at what age did you become a crorepathi, and how did you do it?
Yeah, so we took our savings from the UK. We lived in the UK. I lived in the UK for 17 years. We saved up some money, created a company in London. We sold that. So we had a little bit more money. We migrated to India. And initially when I came to India, this is 2008 May when I came to India, I looked at property prices in Bombay and said, this is just crazy. It makes no sense, right? There's an easy way to figure out property valuation the world over, right? It works in New York,
Can you elaborate?
So you basically take the rental yield of the property. So in India, most properties rental yield is 2 to 3%, right? You look at the home loan rate. If the home loan rate is way above the rental yield, there's going to be a big correction reasonably quickly. So when I came in May 2008, the rental yield was 2%.
Rental yield means the total annual rent that you pay divided by the property value.
Absolutely, bang on. And I said, this makes no sense. So we waited. Lehman Brothers happened in America. Property prices fell by 40% in the next 8-9 months in Mumbai.
Okay.
So middle of
So it's 2008. That's when you bought.
so rental yields of 5% we bought. We had some savings from the UK from selling that company. We used that to buy the flat. So from that point in, fortunately, we've never had to pay a mortgage.
So wait, you were already a crorepati before you came to India, right?
Yeah. So but that went into buying a house. No. So
It went, so you're not considering that as
yeah,
a net
because
worth.
so anything which goes into a business or a fixed asset, it's not really money you can do much with, right?
Correct.
So the proper crorepati thing was when my erstwhile employer started paying me nice bonuses, and then I invested that in the stock market. So that's so 2012 is when I would say I started investing in the stock market properly. So 2011, 12, 13, India went through an economic slowdown. The RBI hiked rates some 10 or 11 times. The stock market tanked through 10, 11, 12, 13, right? All the way till Prime Minister Modi being declared the BJP candidate in the closing months of 13, the stock market was in a downswing. So summer of 2012, I said, was this economy though is going to revive one day. Stock market is assuming that the economy will be tanked for a long time. Templeton had a very good small and mid cap fund at that juncture. So I spoke to my better half and we put the best part of, I think, a couple of crores in Templeton small and mid cap fund. Life being what it is, it doubled in the next couple of years.
Wow.
So
2 crores became 4 crores.
4 crores in the space of a couple of years in a small and mid cap fund.
So how do you determine that? Like a lot of people, when they invest in the stock market, they're like, is this the right time to invest? Which stock should I pick? So how do you identify whether the markets are undervalued, overvalued, or do you not really care and you just invest whenever?
Look at the growth in the company's profits. If the profit growth is significantly faster than the share price growth for say 3-4 year period, you're not going to go far wrong, especially if it's a company with a strong history of good governance, clean accounting, dominant franchise. If the profit growth is consistently faster than the share price growth, you know that the stock is available cheap. You load up as much as you can.
But is that possible? That it's so undiscovered that this company...
So let's take a company that everybody knows about, where for 4 years, profits have been compounding steadily at around 19-20%. The share price has done nothing over 4 years, right?
What is this company?
This is India's second largest company by market cap. This is India's largest bank by market cap. It's called HDFC Bank. So on the one side, people get overexcited. So for example, I would argue there's a good reason to believe people are overexcited about NVIDIA today. Why are they overexcited? Because every man and their grandmother has heard about AI. And they believe, boss, AI hoga to NVIDIA chalega. Right? So when people get into a narrative, when they get into a narrative around a company, then the stock loses all sight of profitability and the stock zooms into the stratosphere. Similarly, there can be a negative narrative. So a lot of people, for whatever reason, right, have got into negative narratives on HDFC Bank. Right?
What is the negative narrative?
So negative narrative is about HDFC Limited kharid liya, usse drag aa jayega, right? So various negative narratives people have built. Most of the negative narratives haven't got any basis in fact. Similarly, if I cast my mind back to May 2020, right? In the early days of COVID, we were first lockdown. Bajaj Finance stock down 65% in the preceding 5 months. And the whole world believing Bajaj Finance is going to get into a lot of trouble. This is May 2020. So we did the math, we did the research, and we said, COVID will end one day. We don't know when it ends. But given Bajaj Finance's financial backing, given the quality of their client base, given their strength in underwriting, if Bajaj Finance gets into trouble, boss, there's huge Armageddon for the financial system.
It's too big to fail.
It's too big to fail. Plus, one day COVID will end. We don't know when it will end. At that time, early May 2020, it looked very dark because nobody knew anywhere in the world what on earth was going to happen. And the Western media loves spinning scare stories around India. So we said Bajaj Finance down 65%. This company is one of the most successful businesses across all industries in India. Let's back up the truck. And we tripled our position in Bajaj Finance. We backed up the truck. The stock tripled in the next 2 years.
Okay.
Right? So this aspect of investing is the hardest part, right? The easier aspect, Sharan, is the start early, play the long game, play the Dravid game, right? Consistent, patient, long-term compounding.
You do not invest in gold, right? And if you see last year, gold has given upwards of 20% returns.
Yeah.
Like, what is the reason for that?
Gold over long periods of time seldom gives you more than 8-9% in rupee terms, right? The Nifty gives you 13-14% in rupee terms. At least with the stock market, you have some barometer, which is earnings.
Correct.
To try to figure out broadly, which direction I should look at. Gold mein to you don't even have that. You don't even have an underlying fundamental that you can track, right? You might say, hey, it's less volatile. But that's not true. Gold is just as volatile as the Indian stock market. So that argument's out of the window as well. And the final reason you could think about buying gold is maybe you say, boss, this can give me diversification.
Correct. Because it's negatively correlated.
But nahi hai. That's not true.
Really?
So gold is positively correlated to the Indian stock market, is more volatile than the Indian stock market, and gives me lower returns than the Indian stock market. So therefore, to my mind, it's a fetish.
It's interesting because I think the conventional wisdom is that whenever the markets are not working well, put in the gold because gold goes up.
Yeah.
But you're saying that if you actually look at the data, the correlation is positive.
That's right. And think about it, right? If everybody knows that conventional wisdom, it ain't going to work. And at the moment, China has destroyed the gold hedge for everybody. The Chinese, because of the troubles in their own country, have loaded up so heavily on gold that it can't possibly be a hedge for anything for anyone.
Was it not possible to know that last year gold is undervalued, so might as well put in that and then ride the
So that's
wave?
a lovely point, right? Where an asset has a real world use, for example, this real estate has a real world use. So you can use the real world cash flows to form some sort of an anchor on the valuation, the rental yield, right, for this property.
Correct.
Stock market mein, the stock ka earnings or cash flows can be a real world anchor to the share price. But with gold or with platinum for that matter, or with any precious metal, that real world anchor is hard to find, right?
Like cryptocurrency. So what is the highest CAGR that you have generated in any given year?
By end of March, when the Indian stock market was down, I think 25 or 30% by the end of March 2020, several stocks in our portfolio were down 30, 40%. That's when we realized there's a huge opportunity to make money. So we organized a conference call, right? For the 300, 400 people we knew then. And we told them that this is a great time to invest. The market is overdoing the panic. The year ending March 21, I think we were up 55 or 56% in the large cap portfolio.
1 year.
1 year, yeah.
55%.
Yeah, and perhaps a little bit more in the small cap portfolio.
Wow.
But then there's been the other side as well, right? And this is why knowing when to load up further is even more important than enjoying your successes. So our toughest year was the 15 months between Jan 2022 till March 23. Right? That 15 months was the toughest year because we were down 15%. Almost all our portfolios fell 15% in the space of 15 months. And profits of the companies were going up.
Okay.
But we broadly knew that what was happening was the Federal Reserve kept hiking rates. I think they hiked rates 4% in 15 months. And the rupee kept falling. So rupee fell from 72 to the dollar to 82 to the dollar in 12 months or so. Obviously, as the rupee kept falling, foreign investors kept pulling out. We kept telling our clients that, look, foreigners are leaving because the rupee is falling. When the rupee stabilizes, this will be fine. So client who loads up at times like that, obviously makes more money compared to the client who runs away. Right? So this is the piece which is very hard to train, right? The load up when everybody else is heading for the exit, but load up rationally.
Now, when it comes to equity, which is the stock market, how do I know how to divide the money between large companies, medium-sized companies, or maybe outside of India? How do I decide that proportion?
Right. So let's do the outside India versus inside India first. So the way we've done it for ourselves in the office, and we've created something called global compounders because of this and we figured out between 30 to 40% of our expenditure is on imported items. Right? If you invest in, let's take S&P 500, just to keep it simple, right?
That's the Nifty of
the
US.
Nifty of America. If you invest in the Nifty of America, there's a diversification benefit you get out of doing that. So just to use 2020 for an example, when we have elections in India, the American stock market is not going to wobble. Right? When they have elections in America in November, the Trump versus Biden election, our stock market is not going to wobble. So in these two markets is where the real wealth is getting created. Then we come to large cap versus small cap. Okay?
So 66% is left.
Right, 66% is left. Out of this, the majority, close to 35-40% is in our large cap product. Right?
Okay.
I have roughly 20 rupees out of my 100 rupees of savings in our small cap product. Right? So in my book, Coffee Can Investing, I have said you should consider between 20 to 30% of your savings in small cap. In fact, there's a chapter in Coffee Can Investing called Small is Beautiful. If you buy too much of this, right, this is more volatile than large caps.
Of course.
Right? So small caps rally more, they correct more, And most people will bail out of small cap investments at the worst possible time. And they will not top up their small cap investments exactly when they should. Given those behavioral deficiencies, I suggest keep your small cap allocation to 30 or below. I have chosen 20 to 30.
So 33% goes outside India, which is the US.
Right.
Another 30% goes into large cap.
Right.
Another 20% goes into small cap.
Yeah.
So the remaining 10-15% is mid cap.
10-15% is the safe harbor, right? So
Achha, okay.
right. So safe harbor. Remember the
FDs.
Yeah, FD that I set aside.
So you didn't mention a mid cap then.
Our large cap portfolio consistent compounders is large and mid. So I'm just using large and mid as one area, because the more bitty you have one large cap fund, one mid cap fund, one small cap fund, it ends up becoming harder and harder to keep track of it.
So would you call yourself financially independent?
There are two ways to think about financial independence. One is the way you said, right? How much money do you need to say I can walk away from
working?
I can walk away from working. The other is to say that I can earn that money through a variety of means. And I'm not dependent on one source of income, one employer.
Yeah.
Right? If you ask me, it took me roughly 20 years to reach that stage in life where you're not reliant on an employer to cut a salary bonus check for you.
Yeah.
And say, I am your God and master.
I did a little bit of reading about one of your previous interviews, and you mentioned that your FIRE number is somewhere close to 50 crores.
Right.
And FIRE number for the audience, meaning you don't have to work for money anymore. So how did you calculate that 50 crore number?
So if you sort of think about middle class Indian life, right? Middle class, I mean sort of holidays to Ooty and Mussoorie rather than holidays to Dubai and London. Middle class Indian life is roughly 50 lakhs per annum gross, right? And net of tax, say 30 lakhs per annum, right?
You mean like expenditure?
Expenditure.
But would you consider this as middle class, like 50 lakhs of earnings in a year?
If it brings me 35 lakhs gross, we try to live modestly, but I think below 35 lakhs per annum is a little tough in a city like Bombay.
I agree.
Right?
That is true.
So I think in a city like Bombay, 35 lakhs.
Especially if you have a family and all of that. Right?
Now, if you retire at 60 and say you survive till 85, live for 25 years, then the maths is pretty clear. Then I need roughly 20 crores in today's money.
Right. How old are you today?
So I'm 48.
So you have 12 years.
Yeah. So assume I retire at 60, but the cost of living is going to go up in this 12 years, right? For example, my employer, Marcellus, we provide a health cover of 10 lakhs to our employees, right? So when we initially started providing this 4 years ago, I thought was 10 lakhs, so, who will need 10 lakhs?
Correct.
Increasingly, I'm seeing every year, out of say our 100 employees, at least 2 to 3 hit that number, right? And when I talked to, recently invested in a Bangalore-based hospital chain, when I talk to the owners of that, they're saying 10 lakhs is not a big deal. If you get some serious illness today, God forbid, 10 lakhs is breached just like that. So again, keeping all of that in mind, right? Keeping how quickly the cost of healthcare is rising, how quickly the cost of imported goods are rising. It's not evident to me that anything less than 30, 40 crores will allow you to have a decent retirement. For a comfortable retirement, my number is 50 crores. And I stress, I'm not talking about some luxurious retirement. I'm talking about a pretty modest retirement. Suppose you tell me, Sharan, that nahi boss, 35 lakhs, I don't need net of tax. I only need 17 lakhs. Even then, when you retire or when I retire, you need something between 20 to 30 crores.
Now, for most people watching this show, they don't even have 1 crore in their bank account, right? So if I were to ask you a question from their lens, that let's say I'm a 25, early 30-year-old person making about 1 lakh rupees a month, and I want to achieve 10 crores by the time I turn, let's say, 50. How should I go about investing my money?
So just to keep it simple, suppose you earn 6 lakhs a year and assume conservatively that you can only save 1 lakh, right?
In a year.
1 lakh in a year, right? For some reason, assume you start work at 25, 26, right? That first year you save a couple of lakhs. That itself, by the age of 55, 60, that itself by the age of 55, 60 will be close to 60 lakhs, right? 2 lakhs at the age of 25 becomes 60 lakhs by the time you're hitting retirement, because you've compounded at 15% CAGR, 15% compounded over 30 years, right? Now, if a person keeps doing this in a disciplined fashion, right? Say 1/3 of their take-home pay, they keep saving through a 30-year career, they will hit the 10 crore number quite comfortably. right?
Okay.
And that's the hard part in savings, right? You got to play a long game, which is why Rahul Dravid is my favorite cricketer. And you got to be consistent in your savings. Now let's assume you haven't done that. Last 10 years, you're saying, I'm not a Dravid, I'm going to be a Dhoni. I'm going to hit it out of the park in the last 10 years. I'm going to finish strong. Well, if that's the case, then in that last 10 years, you got to save 30-40% of your money, and you got to do what I call coffee can investing. Aim for investing in companies that are going to compound for you strongly in that last 10 years of your life. But the sooner you start, the better it is. If you start at the age Sharan Hegde read Coffee Can Investing, perfect.
Interesting. But Saurabh, before we end this conversation, for someone to get the benefits of your investing skills, they need to have minimum 50 lakhs to invest in one of your PMSs.
It's SEBI's rule. It's not a Marcellus rule. SEBI rule that 50 lakhs has to be the minimum for a PMS.
So, but if somebody still wants to kind of, get the benefits of an investor like you, what can they do? Like, what can they do to invest?
So look, I mean, we've tried to describe everything I know in the books that we write, right? So there are 5 books, all available online.
Fantastic. Thank you so much, Saurabh. It was wonderful discussing with you.
Thank you so much for inviting me.
I hope the audience were able to understand most of the things we were talking about. I personally enjoyed it.
Right.
And it was quite a deep finance discussion. Usually we don't go this deep, because we think that, will it be too technical for the audience?
I'm sure, given that you explained things in a much more lucid manner than I did, I'm sure you'll find an audience. Thank you for that.
Thank you so much.